All right, let's talk about one of the biggest stories unfolding in finance right now. I'm talking about gold's absolutely incredible surge to prices that honestly nobody thought were possible just a couple of years ago. Something big is changing, and a lot of smart people think gold is sending us a major signal about what's coming next. So let's dive in and break it down. 64%. Just let that number sink in for a second. That was gold's gain in 2025 alone, a year where we saw, get this, 53 different all-time record highs. This isn't just a market rally, this is a whole new ballgame. It's a fundamental re-evaluation of what gold is actually worth in today's world.
And you might be thinking, okay, that run has to be over, right? Not even close. We're seeing major investment banks put out forecasts of $6,000 an ounce, and some are even talking about a path to $7,000. But here's the real kicker. The whole reason we're doing this explainer. The old reasons for buying gold, they don't work anymore. They don't explain this move. So what on earth is really going on?
Okay, so to really get a handle on what's happening, we first have to talk about what isn't happening. The old textbook, the one everyone learned from for decades about how to value gold, well, you can pretty much toss it out the window. It's officially out of date. The core relationships that analysts built their models on just aren't holding up.
I mean, this right here breaks the number one rule we were all taught. The old playbook was simple. Inflation goes up, you buy gold to protect your money. But the reality in 2026, gold has just kept on climbing, even while inflation has been cooling off. The two have totally, completely disconnected.
And look, this isn't just my take. The financial firm Rothschild & Co. put it pretty bluntly. They said the historical correlations have, and I'm quoting here, broken down. So that leads to the big question. If the old rules are broken, what are the new ones? Well, the answer, according to more and more analysts, is that we are witnessing a deep, fundamental structural shift. This isn't just random market noise. It seems there are three powerful new forces that are completely rewriting gold's playbook for the 21st century. The first driver, and this one is a real heavyweight, can best be described as a kind of slow-motion bank run. But it's not on your local commercial bank. No, it's a run on the US dollar itself. And you know who's leading the charge? The world's central banks. And this isn't just some theory, we have the receipts. China has been buying gold every single month for 14 straight months. Central banks all over the globe are systematically moving their reserves away from the dollar. Why? Well, they're hedging against the risk of things like sanctions and having their assets frozen. This is a huge deal because it shifts the most important buyer in the market from, regular folks and investors to entire nations who buy for very different, very strategic reasons. And this quote really gets to the heart of why this is all happening. Think about it. In a world that's fracturing into new economic alliances and blocs, gold is the one asset that doesn't belong to any single country. It's neutral territory. It is the one monetary asset that everyone, everywhere, can still trust. Okay, the second driver is a little more abstract, but it's arguably even more profound. People and institutions aren't just buying gold to hedge against the dollar losing its spending power anymore. Now they're hedging against the loss of faith in the institutions that are supposed to manage the whole system. They're hedging credibility itself. So what does that actually mean in the real world? It means a loss of faith in fiscal sustainability, especially when U.S. deficits are running over $2 trillion a year. It means a loss of faith in monetary policy, with some really serious questions being asked about whether the Federal Reserve is truly independent. And it means a loss of faith in just plain old institutional stability. In a world full of geopolitical fractures and escalating trade wars. And if you think this is some fringe idea, just look at what the major banks are forecasting. The numbers are wild. Deutsche Bank is looking at $6,000, with a bull case, that's their optimistic scenario, of almost $6,900. Societe Generale is right there with them, and they even warns that their own $6,000 call might be too low. This isn't the fringe anymore. This is the mainstream view of where things are going. All this global uncertainty has accidentally created the perfect real-world experiment. It's put gold head-to-head with its so-called digital rival, Bitcoin, in what you could call the ultimate safe haven test. And let me tell you, the results have been decisive. In 2025, a year of major stress, gold rocketed up 64%. And Bitcoin, it delivered a flat 1%. In the exact kind of environment where a safe haven asset is supposed to shine, the difference in performance couldn't have been more dramatic. But the price in dollars only tells part of the story. If you measure Bitcoin's real value, its purchasing power, in ounces of gold, well, it's been a total collapse. We're talking a 62% drop in just over a year. At its peak, one Bitcoin could buy you 38 ounces of gold. Today, it's just 13. So yeah, the verdict is in. When the real test came, Bitcoin acted like a volatile, risky tech stock. And gold? Gold did what it has done for thousands of years. It acted as a reliable store of value. The market has spoken, and it's shown us exactly which asset it trusts when things get scary. So let's tie this all together. What's the big takeaway? What does this all mean for investors, for you, and for the global financial system? It means we've got to throw out that old playbook and start learning the new rules of the game. The broad consensus among analysts now is that what we're seeing is not some temporary speculative bubble that's going to pop. No, this is a permanent and fundamental repricing of global risk. The market is waking up to a brand new reality. So here it is, the new gold playbook in a nutshell. First, demand is now being driven by Eastern central banks, not just Western investors. That's a structural change. Second, gold is no longer just a hedge against inflation. It's a hedge against wobbly institutions and unpredictable policies. And third, because of all this, gold has shifted from being a nice-to-have in a portfolio to an absolute necessity for preserving wealth. And that leaves us with one final and pretty heavy question. For centuries, the price of gold has kind of acted as a barometer for how much trust people have in the financial system. If that's still true today, what is today's price telling us about the world we are about to enter? Something to think about. Thanks for joining us.